to Financially Fluent with Ray Godleski of Southeast Wealth Partners. Our goal is to equip you with the knowledge and tools necessary to navigate your financial journey with greater ease and efficiency.
Good morning, everyone, and welcome to the next episode of Financially Fluent. Today, we'll be bringing on a CPA. We're going to talk about taxes. There is the one big beautiful bill that has been recently passed, so there's a lot of questions around that. And I thought what we'd do at the beginning of today's episode, just kind of give you a highlight of some of the things you want to be paying attention to, and to really urge our audience to meet with a trusted advisor. You know, it could be an accountant, CPA, an EA, something like that, to kind of go over if you have questions. There's so much in this bill that will apply to everyone, right? Some applies to business owners, some applies to seniors, those that have kids, things like that. So let me kind of just run through the list. So in case any of it does kind of grab your ear, you want to be sure and look into it, find out some more details. Well, one thing is for seniors. If you're over 65, you can get an extra deduction, about $6,000. Extra deduction for those single filers making 75 grand of adjusted gross income or less, and up to about 150 for joint file returns. So that's up to a $6,000 deduction per person. So if you're doing a married file joint return and you qualify, it's another $12,000 additional standard deduction. And then there is a phase out if you're making more money than that. No tax on tips. That is a big one. So you can deduct up to $25,000 of tips. So I know a lot of people will like to hear that. That was something that had been promised, and I was surprised that it passed, but it did. So there's one thing. Another thing would be overtime pay. A single filer could deduct up to, I believe it's $12,500, and $25,000 for a joint return. What else is out there? The car loan interest. So if you're a single filer, you could deduct up to $10,000 of interest, of car loan interest, as long as that car is assembled in the U.S. And if you're married, you could have an income up to $200,000. And there's a phase out that goes up to $250,000 for a married joint return. Student loan interest is still out there, so there's still income thresholds there. But if you're paying back a student loan, you can deduct up to $2,500 of interest as long as you're below the income threshold. So hope that's a good little preview, and hope you enjoy the show. Today I'm really excited to have a CPA with us, Kevin Merck from E.C. Barrett. How was your weekend?
It was good, Ray. I pretty much did nothing, so worked a little bit, and that was it, which is nice.
Do you do nothing around the end of March on weekends?
Definitely not.
Oh, I don't think I gave you a heads up. One of the things our guests get to do is have a little trivia question. I'm going to ask you a trivia question, and as a matter of fact, I'm going to give you a couple of topics to pick from, so I'm not just having to pick it on your own here. It's 90s sports, or music, or history. Which one would you like me to ask you today?
Let's do music.
Music. Okay. Awesome. Here we go. I'll give you a chance to get it right off the bat, and if you're struggling, I'll give you a multiple choice.
Okay.
So here we go. Which artist released the 1991 hit "Everything I Do for You, I Do It for You," which spent a record-breaking 16 weeks at #1 on the Billboard Hot 100? Any idea?
I'm dating myself, but this was played at every dance from junior high all the way through high school.
Uh-huh.
And that is Bryan Adams.
Nice. Yes. Excellent. It's funny. I've been doing these trivia questions for guests, so now I know when I'm ready to get my all-star team for trivia is who to pick and who not to pick. So you'll be my music guy. So awesome. Well, thanks for playing with that. Now, glad you're on. Today we're going to talk about OBBBA, which is a mouthful. And I don't think we've had an episode this year where we haven't started off with an acronym, so today will be no different. And we'll also talk about other just, tax law kind of stuff. And so I'm glad to have an expert on the line here with us. If you don't mind, just tell me a little bit about your background, and then we'll start to get into, I call it OBBA, but you may have a different word for it.
Yeah, I like OBBBA. I've been trying OBBB. OBBBA is just too much.
Too much. Yeah.
So a little bit about me. Actually started at this firm in 2015 as a tax accountant. As just a staff accountant. I am the tax partner now. We're a boutique firm in Sandy Springs. We're a full service CPA firm. We do both tax and audit work.
Okay. Awesome. So yeah, let's talk about first, what is OBBBA, or however we want to call it. What does that even stand for in plain English?
Yeah, we can do OBBA. So OBBA is what it really is, and I've looked at of course, the tax side of things. It's the most significant tax overhaul since the Tax Cuts and Jobs Act of 2017, commonly known as the Trump Tax Act, which really went into effect kind of the 2018 tax year. This would be the most significant change since then. And what it does is, well, the goal was to simplify the tax code. We'll see about that. The other stated goal was to kind of provide tax relief to working class taxpayers, which it does look like there's a lot of beneficial items in this act. And so some of the provisions are to make some of the 2018 TCJA provisions permanent. And then there's also some new additions that are temporary and actually do add a little bit of complexity. And there's some provisions for both individual and corporate areas. So we can go over some of those.
Right. So basically, we think about the Tax Cut Act that from the Trump's first term. We're going to sunset. Now they're not sunsetting. Mostly extended, sounds like, until there's an act of Congress, but at least it would require an act of Congress, which they have done plenty of times over the years. Is that pretty fair?
Yes, and that's important to note. So when you hear me say permanent, that means until somebody else comes in and changes the law.
Yeah.
So, but yeah, there was a sunset provision. A lot of people were worried about this tax cliff that was going to happen, that, maybe the tax brackets would change. All of a sudden you're getting hit with all these provisions at sunset. So those are going to be made permanent. So it offers a little bit of stability and comfort to most of us.
The big ones I always look at are, the 3.8% tax if you're making over 250 for a married file joint, or I believe it's 200,000 for a single filer. That hasn't changed, right?
Correct. That's exactly the same as it was before.
I guess technically it's net investment tax. That's what we're going with, right?
Yes.
Okay. Well, I've heard a couple of thoughts about this law so far, but who would you say is going to benefit from it? Maybe some people that wouldn't necessarily benefit from it. What do you see so far? What are your thoughts about that?
Well, I think families with small children, young children, are going to benefit probably the most from it, and also small business owners. So the child tax credit was permanent. It was fixed at $2,000 before, is now $2,200 in 2025, and it's going to be inflation adjusted starting in 2026. So that's good. There's the new Trump account. We can talk about that a little bit more for new babies in 2025 through 2028. And also we have 100% bonus depreciation now, which is a huge thing from a business standpoint. That's going to benefit small business owners, especially ones that are very fixed asset heavy.
Okay. What are some examples that you would think of that first come to mind on something like that?
Well, let's just say you have a lot of machinery and equipment you're buying, fixed assets, except for like real estate. You're able to take 100% deduction for those.
Okay. Well, I'm thinking of, I have quite a few solopreneurs as clients. Let's say somebody wanted to buy a business vehicle. What would be a reason that they would do that bonus depreciation? And would there ever be a reason they maybe wouldn't want to do that?
Well, vehicles get a little bit that's its own area of
Mm-hmm.
depreciation.
Mm-hmm.
If you're not using a vehicle over 50% business use, it's sometimes better just to take standard mileage
Mm-hmm.
deduction.
Mm-hmm.
So you can either take standard mileage or actual costs. Um, that doesn't change with this act. So a lot of times, especially if the business is being used a lot for personal use, you don't necessarily want to take depreciation on it. It's better to take mileage
Okay.
deduction. And that's something your tax professional can help you
Right.
decide, even at tax return time, as long as you're keeping those records,
Mm-hmm.
which you definitely want to keep mileage logs throughout the year anyway,
Oh, for
no matter
sure.
what you do. The tax professional can help you decide at tax time what is the best way to handle that.
Okay. When I was looking at this new law, looked like if your adjusted gross income is between 500 and 600,000, it might not be so great. Are you kind of sensing that, or what are you sensing on? I know that's a kind of a narrow range, but is that true?
Well, yeah, especially when it comes to the SALT cap,
Mm-hmm.
which is state and local income tax
Mm-hmm.
deduction. One of the beneficial things in this act is with Tax Cuts and Jobs Act, as everybody knows who itemizes, your property tax plus your state and local income tax added together can only add up. You can only get a $10,000 deduction for that. It's limited to 10,000. That's called the SALT cap. Now there are workarounds if you own a business and you're in Georgia. Georgia has a PTE tax. It's kind of a workaround for that. That hasn't changed. That's actually um, allowed for every state now under this act. But anyway, so that has been increased to $40,000 SALT cap.
Mm-hmm.
So but that phases out if you have a quote modified adjusted gross income, which is usually just equal to your adjusted gross income of
Mm-hmm.
$500,000 to $600,000.
Okay.
Once you get to that $600,000 level, whether you're single or married filing joint, it's the same for both. It goes back to the $10,000 cap. It doesn't go lower than that, but
Okay.
if you're making $600,000, you still have that $10,000 SALT cap.
So, I mean, obviously, if somebody's in the W-2 category, they may not have as many uh, moves to make, right? Let's say they said that we're in Q4 and they're like, oh my goodness, I'm going to be right in that corridor. It looks like I'm tracking towards a 550. Is it, if they did maybe a giant charitable donation to bring them into the 490 range, would that work in that scenario or not?
Because the thing is, there's a couple of things with charitable deductions.
Well, what if somebody did like I don't know, 100 grand towards a donor advised fund? Would that help or not help?
Yeah, I mean, it would be the same limitations, whether it's a donor advised fund or just a regular charitable contribution. So so when it comes to charitable contributions, there are some good things and some bad things. There's going to be a 0.5% floor on taking a charitable itemized deduction for individuals, meaning you make $100,000 charitable contribution only above, $500 is you're gonna lose that much. It needs to be over a certain amount. So there are some good and bad provisions for charitable contributions. You have a 0.5% floor for itemized deductions, meaning if your income is $100,000, then you must uh, deduct at least, you must have contribution over that 0.5%, which would be, $500 to even get some kind of deduction. And
Mm-hmm.
for corporations, it's even more. It's a 1% floor. So it's recommended. I'm recommending people don't make charitable contributions if they own a corporation. Another thing is a good thing is that there's a permanent $1,000 above the line deduction for charitable contributions, and that's $2,000 for joint filers.
And that's
So
true whether they itemize or not, correct?
correct. So when we say
Okay.
above the line, that means whether you itemize or don't itemize. Another above the line thing would be there's a new $6,000 deduction for seniors, whether they itemize or not. And that phases out after $75,000 income, just to throw that in there.
Wait,
But
is that for 75 grand for a single or a married?
that's, I
Okay.
think that is for per person.
Yeah, that sounds right. Okay, I think you're right.
This is just a complete bonus deduction for people under 7,500,
Okay. All right.
75,000 or lower.
All right. So just to make sure I'm understanding, I guess looks like there's deductions, but there's also increases in standard deductions. So kind of just walk us through, let's say there's somebody that's 65 or older and their adjusted gross income's around 100 grand. How does that play out for them?
So they're not going to get what's called the bonus deduction, which is a brand new thing. It's temporary. It's from 2025 to 2028.
Okay.
65 and older, if you're $75,000 or under, you're going to get an extra $6,000. For everybody else, and those people, you're going to get an increase in standard deduction. If you're 65 or older, you'll get an extra $1,550 per person, or $1,250 for married individuals.
If you're looking for advice specific to your situation, then take a look at this episode's sponsor, Southeast Wealth Partners. To learn more about their team and approach, go to southeastwealthpartners.com. Southeast Wealth Partners is a great next step to be financially fluent.
All right. Well, one of the other things I was noticing about this is probably the last question on this law that I have, is this car interest. So from what I understand, if the car is assembled in the United States, so it doesn't matter if it's a Kia or a Ford or Hyundai or whatever, if it's assembled here, no interest would be deductible. And I know maybe not everything's been figured out yet, but do we know more about that? I mean, does it depend on your income? Is it starting right now? Is it retroactive? Do you know anything about the auto interest deduction? Is that above the line, below the line?
Yeah, it starts this year, 2025.
Okay.
It's above the line, meaning it's for both itemizers and non-itemizers.
Okay.
Like you said, final assembly has to happen in the U.S.
Mm-hmm.
It is a $10,000 deduction. It starts phasing out at $100,000 for single filers and $200,000 for joint filers, and it's 20% dollar for dollar. So do the math. It would be $150,000 for single filers. I think then that would completely phase out at that point. And some of these things, like you said, they're still even working out the kinks in some of these things. There will be technical changes and things like that to the law. But as it stands right now, it looks like for auto interest that you're paying, if you're paying $10,000 in interest over the year, you would be able to deduct that fully if you're under 100,000 single and 200,000 married.
It kind of reminds me back when I got a car at 0% interest. It doesn't matter if you're paying zero interest, but I guess this is nice since the rates are still kind of high out there. So
yeah, exactly.
It's
it's better not to pay it at all, but
yeah, right. That's good to know. I mean, yeah, I got you. All right, and then I guess the only other thing too is because I got kids that are in college and they serve tables in the summer and part-time, and it sounds like they're gonna be able to get all the tip money, I guess, not taxed. Is that not taxed at all, or just taxed at a regular rate? How do the states are involved? Do you know much about that one yet?
Up to $25,000 of tip income is what. I don't know the conformity for Georgia. That's the big question on all these items. And what states are going to conform with federal? For example, Georgia doesn't conform with federal bonus depreciation currently.
Yeah.
But at a federal level, $25,000 is going to be deductible. It's going to be a deduction no matter what. It's going to be phased out at 10% once you get over 150,000 single or 300,000 for joint filers.
Okay. So yeah, single filer out there and they're making 70 grand waiting tables. That first 25 grand, it would not be taxable. Is that pretty fair?
Correct.
All right. Now let's look at the other class out there, which is the overtime. Somebody's working overtime. If, let's say they're a single filer, they're making 51,000 of normal income, another 12,000 of overtime income. Is that overtime income like completely, income tax free, or just at the regular rate? And what about Social Security tax?
I don't think you're going to get out of the Social Security taxes. And that may change,
Mm-hmm.
but I doubt it.
Mm-hmm.
But up to $12,500 of overtime income, subject to those exact same phase out limits as the tip
Mm-hmm.
income, is not going to be deductible. And that phases out at 10% after 150,000 of income or 300,000 for married filing joint. It's 12,500 per person. So if you're married, you'll get a $25,000 deduction for overtime pay.
Okay. All right. Good. Good. Well, I definitely have some other tax things that are not specific to this new tax law. But is there anything else you thought really stood out you wanted to touch on before we move on to the next
Yes, real
thing?
quick.
Mm-hmm.
Sorry. And I want to
Yeah.
say for the auto interest, for the senior bonus deduction, the tip income, and the overtime thing that we just talked about,
Mm-hmm.
those are all temporary from starting in 2025 through 2028.
Hmm. Okay.
They'll set the sunset after that. Often these things get extended. So
Mm-hmm. Okay. No, that's a good
we
point.
have to do that.
That's a good point.
Another big thing this is interesting, especially for people who may get a 1099 for a small amount of income. Small business owners, you have the qualified business income deduction, which started in 2018. You deduct 20% of your bottom line for your small businesses, except for C corporations. That's been raised to 23%. But not only that, there's a minimum of $400. So once you make $1,000, and I know we're throwing a lot of numbers out here,
Yeah, that's
but
fine.
just to explain that, so say you're a soccer coach part-time, you get $1,000 1099. Well, you'll automatically be able to deduct $400 of that, even though the normal deduction would be 23%. It's a
Okay.
minimum of $400, so that's nice.
Oh, okay. I see what you're saying. Yeah, that's nice.
Because
No,
you're
I think
technically a business at that point if you're getting a 1099. So
now I know when they did the QBI the first time, the qualified business income deduction, they kind of separated out a few class of folks for their income. Are they changing those classes at all? And if they're not, do you mind telling our audience, hey, if you make X amount of dollars, you're not getting a 20% or a 23% QBI deduction?
yeah, I'm not seeing that they changed the specified service trade or business SSTB classification that you're talking about for like consultants, possibly financial advisors, accountants.
Yep.
So we know about that. And I don't see that they're changing that classification, but they
Okay.
are raising the income phase out limits
Okay.
and they're increasing the phase in. So what happens is if you are one of those SSTBs,
Mm-hmm.
or even if you make a certain amount of money, but you're not paying enough in W-2 wages or have enough fixed assets, it starts phasing out. For SSTBs, there's a cliff where it just cuts off at a certain point, and it was around $400,000
Mm-hmm.
of income. They've raised it. They've raised the phase in for that phase out by $50,000 for single people and $100,000 for joint people. So
Okay.
we're talking 450, around 500,000,
Okay.
inflation adjusted.
Okay.
So that can be a big deal for some people that were right around that income level, that maybe you'll be able to get that QBI deduction, whereas you weren't before. That's definitely something where you really want a tax professional look at your overall tax situation
Mm-hmm.
to determine, because there's a bunch of moving parts involved in that.
No, I could agree with that. That sounds like, once again, if you're in the 500 to 600 category.
Oh yeah, they're getting hit the hardest.
Yeah.
For sure.
All righty. So
I'm sorry. Go ahead.
No, go ahead. Go ahead, Kevin.
I was going to say one more thing about that is people in the top. This is important for people in the very top income tax bracket, which starts around, I think it's around 626 for 2025. The top income tax bracket of 37%, your itemized deductions are limited to the point where you'll only be able to take itemized deductions as if you were a 35% taxpayer. And the way that works is 2/37 of that top bracket's income is the reduction.
Okay.
So it's another place where you get hit. You're still getting hit with the net investment income tax. So this is not, when you hear not to get political, but when you hear on the news that this is a tax cut for the rich, that's not necessarily the case.
Right, right. It sounds like it's not getting to be any simpler of a tax code. It sounds
Oh,
like staying somewhat complex.
that
Uh,
sounds, yeah, a little bit
yeah.
like marketing to me.
Well, let's shifting gears a little bit. What are some of the big filing mistakes or planning mistakes that you would commonly see out there?
Sure. A big thing is withholding. That's going to be important right now.
Mm,
Withholding and estimated taxes. The IRS has an online, so since there are so many moving parts in this act, it's going to be important to adjust your withholding to the right level so you don't get hit with a surprise. Um, the IRS does have an online tool on their website that you can use to calculate your withholding. They messed that up in 2018 with the Tax Cuts and Jobs Act, and a lot of people under withheld and were not
mm,
very happy about that. I would recommend having a tax advisor maybe do some planning, tax planning, to determine your estimates and what your withholding should be for your paycheck starting, ASAP, since a lot of these act provisions do go into effect in 2025. Um,
And on
HSA.
that note, just real quick, we're
Mhm.
talking about the withholdings. Uh, I meet people that do take distributions from their retirement accounts. They might do conversions. Is it a pretty best practice to do some withholdings, to try to find a little safe harbor when it comes to that, or it depends? What would you say on that?
100%. I usually, if someone is maybe a high income,
Mm-hmm.
retiree or someone just starting to take distributions from their
Mm-hmm.
retirement accounts, I recommend maybe 25%
Mm-hmm.
withholding, even though the standard is usually about 20%.
Mm-hmm.
Um, I would say 25% is a little better. That's also a financial advisor can help you with that as well.
Right, right.
And I think it's always better to withhold from the distribution if you can.
Okay.
Uh,
Yeah. Uh, Now, are you a fan of HSAs? And if you don't mind, just take a moment, explain that for our audience, just in case they may do it.
What? Yes, I'm a huge fan of HSAs. They're triple tax advantaged,
Mm-hmm.
meaning that unlike just about anything else, your contributions are deductible, it grows tax free, and the withdrawals are tax free as
Mm-hmm.
long as they're used for qualified medical expenses.
Mm-hmm.
Um, and in certain cases, the medical expenses could be in a prior period that you're paying for. Going in, coming out, and it's growing tax free. I mean, you can't beat that, in my opinion.
One of the things that I think people might not be aware of is, let's say you're working and you got good income coming in, you're putting those money in HSAs and you're using other assets for medical purposes. Is there any statute of limitation on how long you keep those receipts for medical things that you did not use your HSA account, and now all of a sudden, you're in your 80s or something like that, but you've done a great job of keeping these receipts, and you're like, you know what, I feel like using my HSA account to pay for past medical things that were unreimbursed. I feel like reimbursing myself for that. Is there any kind of statute of limitations on that?
Yeah, and that's kind of what I was getting at. You can go back retroactively and reimburse yourself for those medical expenses with a current HSA
Mm-hmm. Yes.
distribution.
That's been my understanding as well. I guess technically speaking, if somebody's so organized and they had their grown kids, in a situation where they could use use that account, maybe they got financial power to pay for someone that's not doing well and probably isn't going to make it. They could kind of step in and use those HSA dollars in that scenario. You agree with that?
Yes, I think so.
Okay. All right, very good. So when we're looking at small business owners, right? So think of our economy. We don't even realize this. We only hear about the big companies, right? The Fortune 500 companies. They get all the headliners, but the reality is our economy and our workforce is really a lot of privately held businesses. And so for these small business owners that are out there, what would be kind of a framework that they should think about really prioritizing when it comes to taxes and how they're organizing their businesses?
Get a bookkeeper, I
Yeah.
would say.
Right.
A lot of businesses think that they're not at the level where they should have bookkeeping services or accounting services. It's really, I would say most of the time you're causing more problems for yourself by doing that because you're kind of scrambling, especially at tax time, or if you have to provide financials for a loan or something that's not necessarily something everybody foresees. So, pertaining to this act, I would recommend going ahead, if you're looking to make capital improvements, go ahead
Mm-hmm.
and make those in the next couple of years while you have 100% bonus depreciation. And one
Mm-hmm.
thing I didn't mention is Section 179, the overall limitation's been raised to 2.5 million.
Okay. Yeah.
So in certain circumstances, it's better to take 179 or bonus depreciation. That's something you want to talk to a tax advisor about, but a good tax advisor will do what's best in that particular situation. But
Okay.
those things could change, with another law. So
I heard this from another accountant before. I wanted to see if is this just kind of normal and common, or is this more unique and only a few do it? I'm just curious about you guys. They were doing two sets of books, if you will, all above board and everything, but one for tax return purposes and one more for the business side when it comes to line of credits and things like that. Is that somewhat common out there?
we usually recommend our businesses just keep one set of book. There's nothing wrong with what you're
Mm-hmm.
talking about.
Mm-hmm.
It's usually easier to keep one set of books on a tax basis, especially if you're a smaller business.
Mm-hmm.
And maybe you're not subject to the GAAP rules. You're not getting your financial statements audited and stuff like that.
Mm-hmm.
Um, if you're getting audited, reviewed financial statements, you want to follow the GAAP financial accounting rules. And so you may have a separate set of books for tax purposes that are you're on a tax basis of accounting as opposed to which may be cash basis instead of the accrual basis books you would normally keep for GAAP purposes, if that makes sense.
I think so. I think so. The other thing that comes up very commonly is, hey, I've been a sole proprietor and so and so told me to be an S-Corp. What, when, is there I guess, the amount of money that they make where that makes sense? Do you have a general rule of thumb when someone might want to change from a sole proprietor to an S-Corp?
Yeah, I do. This is one of my favorite things to recommend to people because it's always a pleasant surprise when they can see how much they're going to save by changing to an S corp.
Mhm.
Because if you're a sole proprietorship, of course, you're paying all that self-employment tax in addition to income tax, which is really a burden sometimes. I would say I usually recommend about $50,000 at this point,
Okay.
especially with the Georgia PTE tax election, which is an additional benefit because if you're a Schedule C sole proprietorship, you can't take that. You can't get around that SALT cap, even if it's 40,000. The Georgia PTE election, which is now permanently allowed, is gets around that no matter what your income is, and it's already becoming advantageous at 50,000. Now with the 40,000, we can go back and forth about whether it's better to itemize with the higher SALT cap or to take the PTE election. Probably going to recommend people keep kind of paying the tax at the entity level for state purposes.
Okay.
So 50 to 100.
Okay.
I mean,
All right. That sounds about right. And I guess, is there any kind of underrated tax saving tool that you found that you think people, and let me say this to the audience, always do your own due diligence, whether it comes to investments, taxes, insurance, but hopefully, this episode and previous ones and future ones, it's making you think. You really want to, do some thinking through how can we, find some tax savings or whatever it may be. So, but yeah, Kevin, what would you say is just an underrated tax saving tool that you found that maybe is being underutilized out there?
Keep track of home office. If you have home office, keep track of those expenses, all your utilities, any repairs to your house. You may be able to take a portion of that for home office. Track your mileage diligently, because the IRS will disallow it, in the horrible case that you get audited. They will see contemporaneous mileage logs. The HSA is a big thing. Take advantage of that. Take advantage of 529 plans. If you have children of any age. Yeah, those are the big things. Maximize your retirement contributions.
On the 529s, if you're the parent and you put in, let's say, $8,000 into a 529 for one kid and $8,000 for another kid in the state of Georgia, you're going to get a Georgia deduction from that. Is that fair?
Yes, you'll get 100% Georgia deduction for that. You'll get a $16,000 Georgia deduction.
Okay. Now you go over that, you can still do it. Of course you can, but you won't get is the 8,000 still kind of the cap at the moment for Georgia?
Yes, I think as far as what I've read, $8,000 is still the cap. Go ahead.
Yeah, so I guess, that grandparent, they live out of the state, and they're helping their grandkid out in Georgia, and maybe their grown kids live in Georgia. That's not going to really, I don't think anybody's going to get that deduction, but maybe the grown kids are struggling and they gift them the money, and then the parents were to put money in that 529. I guess that'd be one way for the parents to benefit. Do you think so?
Yeah, that would be a good way to do that. Yes, it has to be a Georgia. That's important to make sure you're contributing to a Georgia 529 plan if you're a Georgia resident. People have Alaska plans and stuff. They don't get that Georgia deduction, and there is no federal deduction for it.
Yeah, it's interesting. It really is one of those cases where you have to evaluate what's out there. For example, if a Utah plan or Alaska plan has better investment options and maybe you're not even getting a big deduction off of it, some people just find themselves going out of state to do their 529s, even though it's for Georgia. So it's nice for people to have options. I think they should always seek some professional advice as to which is the best 529 plan for them. All right. Well, just to kind of recap for our listeners today, we went into the OBBBA or OBBBA. I don't know what name we're going to call it. OBBBA sounds too much like a bond you don't want, but it's got a lot of good stuff in it. It's, and it is what it is. So, and I have a feeling just because there's opinions today, IRS gets involved and they may add some clarity to some of the provisions that are in there. And is there any kind of last second things that you would want to say before we kind of close up here?
Only thing I would say is, speaking of last second, don't wait till the last second to look at some of this stuff. So get with your investment tax advisors throughout the year.
Yes.
And early on, especially if you're looking to make some kind of major decision, home sale, you have a birth coming up, something like that. Get ahead of these things. Don't wait until April to try to deal with it, because sometimes that's too late.
Good point. It makes me think we're recording this mid-July. It'll be released in August. For those business owners out there and they're thinking about a 401k, you got to get on it. That safe harbor sneaks up on you quick. And there's a lot of kind of things you got to get going prior to that new plan getting up and running. So keep that in mind for business owners out there. I definitely want to thank Kevin Merck from EC Barrett today. I know you guys over there got a nice firm, nice staff, so appreciate you being on here today. And just to kind of give our listeners a heads up, what are some episodes coming up? We'll have, we're going to talk about private investments. We're going to talk about, I think who else we got coming on. I think we have another estate attorney coming on. So a lot of good stuff coming up. So thanks for listening today. Please subscribe and share Financially Fluent, and look forward to seeing you on our next episode.
Thank you, Ray. I really enjoyed it.
Thank you.
Thank you for for listening to the Financially Fluent podcast. Click the subscribe button below to be notified when new episodes become available.
This communication is for informational purposes only and should not be considered tax, legal, or accounting advice. You should consult with a qualified tax professional, accountant, or legal advisor regarding your specific situation before making any financial decisions. Investment advisory services are provided only in compliance with applicable laws and regulations. Ray's opinions are not based on the specific financial situation of any investor, so they may be unsuitable for some investors. The information on Financially Fluent does not constitute a solicitation of the sale or purchase of securities. You should consult a professional advisor before executing a security trade or taking any other action based on information contained in this program. Securities and investment advisory services offered through Osaic Wealth, Inc., member, FINRA SIPC. Osaic Wealth is separately owned and/or other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.